Hello, everyone, and welcome to How I Built This Resilience Edition. How is everybody doing today, this week, end of the week? Hope you are doing okay and staying healthy and safe. As you know, this is the place where we are exploring how businesses are building resilience in the midst of this crisis. We're taking your questions for our guest today, Jon Stein of Betterment, on Facebook, on YouTube, and on Twitter. Before we get to Jon, I just want to thank Comcast Business for supporting NPR and How I Built This during a time when we really need the support. So thank you, Comcast Business. They are prepared for times like these, powered by the nation's largest gig speed network to help give you speed, reliability, security, and the tools to manage your business from any device, anywhere, and a team of experts 24/7. For more, go to comcastbusiness.com. We couldn't do these shows without your support, without their support. So thank you, Comcast Business. Okay. I am sure you have seen the headlines today. The U.S. unemployment rate is higher than at any other time since the Great Depression, close to 15%. 20 million jobs were lost in April, and May is unlikely to be any better. A lot of people have been watching the value of their retirement savings dwindle, their 401ks going up and down. The markets have been on a roller coaster ride. So to talk to us about some of this, we've asked Jon Stein to join us. He's the co-founder of Betterment. Betterment is an online investment company that was actually started in 2008. We'll get to that in a bit later. It was started during the Great Recession. We featured Jon's story on How I Built This. It's well worth listening to that. So you can go back to your podcast queue and check that out. Otherwise, Jon, welcome. Thank you for being with us. Uh-oh. I think we lost Jon. Okay. We're going to try to reconnect to Jon. Jon, are you there? Uh-oh. All right. We'll try to reconnect with Jon in a moment. But while we are waiting for Jon, let me just give you a bit of an update on some of the cool things that we've got lined up for next week. We've got Toby Letke, the founder of Shopify, who will be with us on Wednesday, and Andy Puttycombe of Headspace, the co-founder of Headspace, and also Rich Pearson, his other co-founder. They will be with us on Friday. Andy will talk to us about, mindfulness and kind of using meditation and some of the techniques that he uses to help him cope with stress. He's just an amazing person. Both Toby and Andy Puttycombe of Headspace were on How I Built This on the podcast. So check those episodes out. You can also check out all of our How I Built This live conversations, these Resilience Edition conversations on our Facebook page. That's facebook.com/How I Built This. They're also on the NPR YouTube page. We've had incredible conversations over the last 4 weeks with people like Jon Stein and Tony Xu of DoorDash and Stuart Butterfield of Slack, and Jenny Britton Bauer of Jenny's Splendid Ice Cream, and Alice Waters, and amazing people. So go and check those out. Monday, we've got a brand new episode of How I Built This coming out. It is really one of the most incredible stories. It's Impossible Foods with Pat Brown. So I'll tell you more about that later. I think Jon Stein is back. Are you back, Jon? All right. I know you are in upstate New York, where you're kind of running Betterment out of your house there. And I know the connection is not great, but how are you doing, by the way, in general?
I'm doing well, thank you. We feel really lucky to be here, not in our 800 square foot New York apartment with our two daughters. It would be just a lot to manage in there. Here, at least we can get outside. They can get outside, more importantly, and run around a little bit.
So for people who don't know about what Betterment is, it's an automated investing service. Sometimes they're called robo-advisors. And that allows you guys to charge a fraction of the rates that other investing services charge. You don't require any minimum amount. By the way, what is the average amount of a Betterment investment?
So the average customer today has about $40,000 invested with Betterment, but we have people who are just starting out who have $100 or less invested with us, and we have people who have tens of millions of dollars invested with us.
And that's 401ks and just general investing.
Right. We say we're a smart money manager. We take all the things like a great financial advisor would do if you had one, and we make them smarter, faster, cheaper, and better.
All right. Now, I know in 2019, you had about $16.5 billion of assets under management. Tell me how your business has been affected by the market volatility.
So we have $22 billion under management today. We have about just over 500,000 customers. We have seen both sides of this volatility, and we've seen the hit because our business depends upon assets under management, and when the market is down, customers' portfolios fall, and that directly impacts our revenue very immediately. On the other hand, we've seen record sign-up volumes. We've seen more people coming to us than ever before in Q1, even in March and continuing into April, records. And I think some of that is people, no matter where their money is invested or no matter what they're doing, are being impacted by this crisis, and they're reevaluating and thinking about, are they getting what they need from their money management? We've done some surveying and found some interesting things about that.
I want to ask you about that survey because I've read about it, but before we get there, I mean, I'm wondering, Jon. I mean, the natural reaction we've heard this through crises in the past, like when the market starts to dive, people's natural reaction is to pull money out because they're freaking out. They don't know how low it's going to go, and certainly people have pulled money out of the stock market because they're worried that they may not have cash to just live off. Have you seen significant numbers of your customers withdraw their money or some of their money?
You bet. And I have so many anecdotes about this, and it changes every day, right? Starting off, my own parents called me up and said, Jon, we're thinking about withdrawing some money. It would just make us more comfortable to do so. This was on actually the day the S&P 500 reached its absolute bottom. And I said, I think we've talked about this. The idea is to stay the course. We're going to manage your money smarter over the long term. You don't need to react in the moment. And they said, well, it would just make us more comfortable to have a little more cash on the side. And I said, your plan is we've already got enough of a safety net for you. You're fine for the next few years. You don't need it. But people react emotionally to the market. And I guess I'm just telling that anecdote to say it happens to me, my own family too.
Yeah.
Fortunately, they kept most of their money invested, but I couldn't stop them from withdrawing a little bit. Now, I think it's interesting that among all of our customers, only 2% more customers withdrew in March than did in a normal month for us. And by far more customers were depositing than withdrawing. So 26% more of our total customer base was depositing ad hoc, not just auto deposit, but actually actively putting more money in and pulling money out. And for millennials, the most interesting thing is that for millennials, it was 37% more were putting ad hoc money in than withdrawing. And there's something there about how these younger customers are reacting younger people are reacting differently to this crisis than, say, the boomers or Gen X is reacting to it.
Well, which would make sense because they have more time to see the value of their portfolios recover. But I mean, this seems, and I know that the conventional wisdom has always been, you got to ride it out because over time, if you've got a 401k or any savings, over time, there will be years and moments where you will lose, but over time, you will make money from your retirement savings, or your 401k, or whatever that might be. But I mean, is there a possibility where this is different? I mean, even Warren Buffett, whose sort of playbook has been be greedy when the market, is getting hammered, and be parsimonious when the market's overvalued. Like, he's not even buying stocks right now.
I listened to some excerpts from his talk his recent annual letter, and I think what he's saying is maybe he's not seeing the values, right? He's not seeing like the deep depression in prices that he looks for in a downturn because things rebounded so quickly. I mean, the market was down 30% for a minute there. And then bounced back faster than certainly any of us anticipated. And in that time, the boomers, people like Gen X and my parents and so on, were much more likely to react to that. And it's interesting because many of them were investing in 2008. and saw that downturn, and then saw things come back up pretty sharply. And for me, the lesson would have been learned in that time to just stay the course and don't touch your retirement savings, because you can't time the market. Just leave it alone. But somehow that's not the case. Younger people maybe learn that lesson, better than their parents.
We're taking your questions, by the way, on Facebook, on Twitter, on YouTube. So please ask away questions for Jon. I wonder, Jon, whether, you talk about 2008, and we'll get to this in a moment because you started your company in 2008. But, by 2012 or 2010 even, a lot of people who saw their portfolios collapse or their retirement savings collapse, they recovered by 2010. Is there a world or a possibility where this is different, where this is more like 1929, where it could be a decade before we see a recovery?
Well, we've had such a long bull market too, right? It feels like we've been in the good time since 2008, and so I hear that. We're also seeing record unemployment, right? We've got 15-ish% unemployment nationally now, which is just awful, and yet the market seems to be optimistic. The market seems to think that things will bounce back relatively quickly on the other side of this, that those jobs will come back. I say Betterment was built for times like these. I mean, we were born in that last crisis, as you say, which was more of a financially driven crisis, and we didn't see the levels of unemployment that we're seeing right now, not even close. But it was there were problems there in finances that made it very hard for businesses to start lending again, for the financial system to start moving again, and maybe this time is different in that we can get back to work more quickly. That's certainly the hope. We've seen in our own portfolio, we manage, as I said, $22 billion, and in March we traded $8.5 billion on behalf of customers. That's more than a third of our total AUM, and most of that, over $7.5 billion of it, was two-sided, meaning we were tax loss harvesting for customers or rebalancing customers. And of course, in this time when we're rebalancing, we're buying on the way down, and then you get to ride the market as it rebounds, which is exactly what people should be doing in times like these. And I built Betterment in the last crisis, thinking if people had better financial advisors in times like these, they could be better off. And so I feel like we've been well prepared for this moment, and now we're being tested, and I'm happy to see that the system and the service is performing as expected.
And just to be clear, Betterment doesn't invest in individual stocks. What you are investing in are giant funds and ETFs, and you're right. Am I right about that?
Exactly right. We're buying exchange traded funds, and our customers have essentially diversified portfolios that cover the entire global market. Right. I wouldn't recommend to people to go out and trade stocks. I think when people think sometimes about investing, they think go and buy GM or Ford or something. And no, we're not recommending that. That's just gambling, and it can be fun, but it's not what we're about.
So, Jon, I'm curious. If there are some people who are withdrawing money, right, and because they are worried about their financial situation. If they have a small business, they're not getting. They have the revenue's not coming in. If they've got a job, some people are being furloughed, or if they're lucky and they still have their jobs, or their pay cuts, salary cuts, and reductions. Your business depends on accounts, on more and more accounts, right? Because your margins are so thin. You're only charging a quarter of a basis point for people to manage people's money, which is tiny. It's a tiny amount of money. So, what explains the fact that your overall business isn't affected by it? That your sort of revenue stream seems to be more or less the same?
So we are affected. We feel it too. But I feel lucky in many ways that we're not say, dependent upon people to come in to a branch or into a physical retail location in order to hand us money for our services, right? We are a digital business, and right now, actually, digital financial services are doing, I'd say, as one of my board members said to me this week at our meeting, you're in the top quadrant, right? Like, things might be tough, but you're lucky that you're not, say, a restaurant or one of the, there's so many businesses that are being hit hard.
Right. Right.
We're not online conferencing software. We're not a delivery business. There are certainly things that are better positioned in this time. But I think customers are, we're still seeing record sign-up numbers. We're seeing people coming to us, and it's interesting because especially younger people are losing jobs. We saw that in our survey, of millennials, I think it was like 30%, 33% of Gen Z lost jobs in our survey due to COVID, versus only about 8% of the baby boomers had lost jobs. And so you can, of that 15, total unemployment, you can see who it's impacting. It's impacting everyone, but particularly younger people. And yet they're the ones who are more likely right now than ever before to be signing up. We're just seeing a surge in especially young people signing up.
Yeah, I mean, it's in this survey you're referring to. You guys did a survey. I think you surveyed about 5,000 investors, and it's public. It's on your blog, and I looked through it, and I saw something really interesting. And you kind of mentioned this earlier, but I want to dig into this for a moment, which is, you would think that investors, like experienced investors who rode out the 2008 financial crisis, would be more resilient today and would be kind of watching this and saying, let's roll with this. But actually, what you found is that they are not any less stressed out than new investors. Like in some ways, they are more stressed out.
Exactly, and I think part of that is, if your time horizon is short to need that money, you're going to be more panicked than if you have another 20 plus years to save and invest, and that's for the long term. You don't have to worry about it. But I don't think that fully explains it, because for our investors who are closer to retirement, we're recommending more conservative portfolios. We're putting them into more cash. We're putting them into more bonds that are less volatile in times like these. And nevertheless, they're more concerned. They're more likely to withdraw than the younger customers. And I think there's something about listen, I don't know. I'm hypothesizing, but I think there's just something about those of us, or people even younger than me. I shouldn't include myself in the millennials. But young folks maybe having grown up in the tech bubble, followed by 2008, just a little bit of a sense that like things come and go, and just like this is a buying opportunity. We've seen we are farther from, say, the Great Depression. We're farther from like the significant downturns that lasted for decades, and we're closer and more familiar with these more V-shaped downturns that we've seen in the past.
We're getting a lot of questions in from Facebook and from YouTube and from Twitter. Let me go to a question from Gerald Kesswater. He writes, he says this $1,200 stimulus check is extra money. How should I invest this? He says he has it now in a savings account through a local credit union. What do you recommend people do with the $1,200 stimulus check if they got it?
I've been amazed at how many people are getting that stimulus money and saving it. We would expect in this time that when the government is pumping money into the economy through this stimulus, that people go out and immediately spend it. But I read numbers last week that the national savings rate has jumped from 9%-ish. It's been falling, since 1965. It's been coming down and down. And it bumps around 8-9%. It jumped to 15% at the end of March, maybe even higher in April. People are saving so much more. And even this stimulus that's meant to help them pay the bills or get through the month, people are saving that. And it's in part because there's nowhere to spend it. Like you can't go out. And I wonder too, if younger people, like especially living through this, are going to be more focused on savings and think more about, putting that money away. in our own customer base, we saw about 55% of customers put it into a short-term savings vehicle, like that community bank that this questioner asked about, or our cash reserve fund that we have at Betterment. We're seeing another 40% put it into long-term retirement savings, things like an IRA or a 401k. And actually, the smallest minority, maybe it's 15%, is putting that money toward, say, an immediate spending need. So pretty striking.
I mean, the savings rates are so low right now. The interest that you're going to get on sticking in a savings account, even in the better with better options. I mean, Betterment probably has a slightly higher rate than your local bank. But I mean, is there? Would it be better? Would you be better off putting that money into a general index fund, or like a low interest or no fee or low fee fund?
It always depends on your situation, right? And there's a bit of a ladder, right? So if you have immediate bills that you need to pay, keep the money in your checking account, make sure that you're paying those off first. If you have high interest debt, credit card debt, or something like this, and all your immediate needs are covered, you want to be paying down that high interest debt. What's high interest? Generally anything higher than 5%, I would think about as like high interest, and start to pay that off first. If you have low interest debt or no debt, if you're one of the few lucky folks in this country who have no debt, then you should start thinking about maybe putting that into a longer term savings vehicle. If you don't have 3 to 6 months of cash saved as a rainy day fund, put it into a savings account or a safety net fund. If you've got more than that, start thinking about longer term savings.
Cool. Thank you for that question. This is from Javi Ramirez. I'm probably a Betterment customer. He's asking, do you have any plans to implement budgeting tools into Betterment?
Yes, we do. That's a great question. We're so excited about budgeting right now because we're hearing a lot more demand for it in this time. People are saying, am I on track? Am I saving enough? We launched in just a couple of weeks ago, we launched our Betterment checking account publicly. And you might say, why launch it in this time? Well, we picked April 26th before the pandemic hit as our launch date, and we stuck to it because we've been hearing from customers that they needed this, that they wanted a bank that was on their side, that didn't have any minimum fees, that didn't have any annoyance fees, and actually paid interest on your savings. And so we launched. We're excited about to have that out in market. And we have some budgeting already. We have savings for goals and keeping you on track to those goals. You'll see more to come along those lines in the months to come.
Jon, I want to ask you to put your entrepreneur hat on for a sec, and not your sort of finance CEO Betterment hat. I mean, you started this business. You were a young trader at Lehman Brothers when it collapsed, or like right around the time of the collapse. And this is 2008. I mean, you were out of work, and I mean, you started this business at a time when it was hard for you to get investors on board. The money was tight. I mean, to sort of talk us through a little bit about this moment. I mean, if you are thinking about starting a business, or you were thinking about starting a business, and then this crisis happened, what advice would you give to somebody who's in that situation?
I mentioned that we were born in the last financial crisis, right? We were born in that downturn. And at the time, everyone was saying, this is an awful time to start a financial services company. Don't even think about it. And I said, like, this is when we're needed most. Like, this is, people are losing their shirts and they need a financial advisor, and the banks are closing and no one trusts the banks anymore. This is the time to launch it. It was a hard time to raise money. It was a hard time to get started. But in retrospect, our success is as much timing as it is anything else, right? It was the right time to launch this business. And we did enjoy a long bull market for many years thereafter. Now, in this moment, I've heard this question too of, is this a good time to start a business? Like, I've lost my job. I've been thinking about starting something. Maybe this is that moment when I should do it. And my answer is yes. I would say, when a downturn is actually a great time to think about starting a business, especially because you might have more free time on your hands and you can finally focus on doing that thing that you're passionate about or solving that problem. And there are so many problems right now to solve, and so many novel ways of solving them. What I think, everyone has their own interests and should focus on what makes them, most excited and help in making the world a better place. But for me right now, I always say, I think there are three areas that are particularly ripe for disruption: financial services, healthcare, and education. And technology is going to change these three areas more in our lifetimes than any other things. And financial services, you get it. Healthcare, wow, like right now, there's so much telemedicine happening, different forms of drug, prescription writing, and just we're able to use technology, and we should be using technology in a much better way than we are to track patients. There's so many opportunities that are being that light is being shown upon them because of this crisis. In education, my daughters are in the other room doing their morning meeting with their like kindergarten. Where you never thought technology would be used in this way in the kindergarten classroom. And I'm finding amazing. It's not all great, but there are parts of it that are really interesting and good. And I think we'll build on those in the decade to come.
What about with your team? I mean, you've got, I think, about 250 employees at Betterment. Is that right?
About 300 now, yeah. In New York, Philly, and Denver, and about a dozen all across the country.
So you already have remote offices, but your main headquarters is in New York City, obviously the financial capital of the US. You're functioning, you're operating. I mean, you right? I mean, you guys are doing Zoom meetings, and probably you're almost as productive as you could be in the city. We're working remotely. We're making our show remotely. We're functioning. To our listeners, it doesn't sound any different. How is this going to change the way you guys operate? I mean, presumably, people are going to start asking questions like, "Hey, Jon, do I really need to live in New York City? It's really expensive. Can I live in Southern New Jersey and do this job? Or can I live in, Western Pennsylvania or wherever?"
We've been talking a lot about this and hearing a lot about it from our team. I've got a lot of it depends upon where people are in life. I find, we've got young folks who have weathered this out in Manhattan the entire time, and they just cannot wait to get back to the office and get things back to the way they are. We've got parents who are holed up with children who say, "I've got to get out of here. I've got to get back. I need that office. I can't function at home." But then I can think of dozens of team members who are now thinking about moving to the suburbs, or I've already, made some steps in that direction, or even to the Midwest or to the Southeast. People are definitely thinking that this is working for me, and there's things about this arrangement that I like better, and it will change the way we work. I think because people are having forced into this. I used to think I couldn't possibly work from home. As the CEO, I had to be there every day. It felt essential. And this has shown me that I was wrong, and so it's interesting.
I really hope that this crisis sort of restructures and reorganizes where people live and build businesses in the United States, because New York, San Francisco, Los Angeles, Boston, Washington, D.C. have kind of sucked a lot of the money and the talent. And I can imagine a world where people say, well, why do I need to live in San Francisco when I can live in Omaha, or I can live in, Cheyenne or Kansas City or another part of the country where, you can imagine whole, just incredible businesses and industries rising up from those cities once again. We think about St. Louis and Cincinnati, which were these incredibly important industrial cities in the 19th and early 20th centuries. And, a place like St. Louis, you could imagine could become that again.
I 100% agree. And there's a lot of, all of these are beautiful cities that you mentioned, and great places to live. And I've seen, we started about 2 years ago to hire remote workers. We've got someone on the team who's an engineer who's also a state senator in Wyoming. We've got somebody in Kansas City. We've got people in Austin and all over places where we don't have offices, Indiana, et cetera, people are working from all across the country for Betterment, and this is allowing us to lean into that now. And I think we'll continue to hire remotely. I think it'll be a strength of ours. My head of people, Lucy, raised a really interesting point in our exec meeting last week, and she said, "Look, we've always been a company that has had a good central hub in New York, and you, Jon, love creating that sense of community among the team. Like that is a selling proposition of working at Betterment, is being a part of that. And we can continue to be good at that. We might be great at it, but can we also be great as a remote company? Do we have the bandwidth to be great at both of those things? Like we do lunch for our team in New York. How are we going to do that for remote workers? Do they get a budget for it? So being great at both is a new challenge, and it may not be possible. Companies may have to decide: are we location specific focused, or are we great at remote? Certainly, we're swinging in the direction of being better at remote now.
Yeah, we're doing virtual lunches once a week as a team. I mean, it's a little hokey, but it's nice. It's actually really nice, and we obviously have daily meetings, and we made sure that everybody on the team got a nice little care package of ice cream, and it's cool. It's really nice to do that. Jon, before I let you go, what is one thing that you want to take away from this crisis, like that might change your mission or might just influence how you think about the culture of your organization or what your purpose is? In 5 years' time, if you could say, this is how that crisis made us a better and more resilient company, what would you want that to be?
I think being remote is a big part of it, but where my mind goes immediately is something that my wife said to me yesterday, which was that, it's so nice that in this time you've been home for dinner with us every night. And in our 10, 12-year relationship, like that's never been the case. You've never done that. And I realized that we were doing it, and it's been really nice, but it didn't occur to me that I'd never done that before so consistently. And I hope I keep that, if there's one thing I keep, and it's going to be hard, we're all going to go back, someday, and things will be in some ways back to the way they were. But just having dinner with the family has been pretty special.
I love that. Jon, stand by. I just want to thank a couple people watching: Jody Davis in Lynchburg, Virginia, Catherine Morse in Worcester, Mass, Yasuo Imamura in Tokyo. Thanks for watching. Kylan in Hayward, California, Dante Richardson in Los Angeles, many more. Thank you for watching. As I mentioned earlier, and I'll just briefly mention it again, if you enjoy these conversations, we post all of these on our Facebook page, facebook.com/howibuiltthis, and also at the NPR YouTube channel. And please share these with your friends and family if you enjoy them. We've got tons and tons of these conversations archived there, and you can watch them. We do post excerpts on our podcast, so listen out for that. Next week, Toby Ludke of Shopify, the founder of Shopify, will join us on Wednesday. That's 9 Pacific, 12 noon Eastern, right here. And then next Friday, Andy Puttycombe of Headspace and his co-founder, Rich Pearson, will join us. If you use Headspace, you know Andy's voice. He will be here with us next Friday, and that's also at noon Eastern time. So join us for that. We are going to be posting excerpts of these. They will show up on your podcast feed every Thursday and Saturday. And as usual, every Monday, we've got a brand new episode of How I Built This. So please, if you're not a subscriber, check it out. This Monday, we've got Pat Brown, the founder of Impossible Foods. It's an amazing story. He was a tenured professor at Stanford, and he left because he wanted to change the world. And he thought, maybe I can change it by getting people to eat meat that comes from plants and not from animals. It's an incredible story. So check that out. Jon Stein of Betterment, thank you so much for being here. I saw you in New York and met your girls and your wife back in, God, it seems like forever ago, but it's just a couple months ago.
It was only 2 or 3 months.
You guys came to our Wow in the World show, the kids podcast I do. We did a show in New York, and they came to that show. It was so fun. Great to see you. And I hope stay safe, and hope to see you soon, once this is over.
Thanks, Guy. Hope to see you on the other side in person again, and be well. Glad your family is well and safe.
Thanks. Bye, everybody.